Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors. Valentine's Day, 2/14. I hope you got your flowers. I still have to get those. Couple of quick notes this week. How about how treacherous these earnings reports are? Even for companies hitting their numbers, there was multiple drawdowns this week of 10, 12, 15%. And beats and moves higher. But for some reason, those drawdowns really caught my eye. Just showing that although the market was solid this week and has been solid year to date, there's a lot of landmines out there. A couple of the areas that continually push out landmines are tending to be in semiconductors and in defense, believe it or not. Let's take semiconductors first. There's a real tug of war within traders and investors' minds right now, leaning on, has AI pulled quite a bit of business forward? Some of these hyperscalers, these companies growing so quickly like Amazon and Google and Microsoft, can they continue or will they continue to expand their CapEx, their capital expenditures? Some of the companies, the market voted this week that may not be the case. A couple of them are very impressive companies. We have some cash in Tactical Trend. We have some cash in US ETF. Some of these names are getting interesting on Tactical Trend, which can own individual stocks. We'll keep an eye on a company like ALAB, A-L-A-B, Aster Labs. They've really taken it on the chin. A company on out years showing tremendous growth. Again, we have to make a bet on whether that growth will come to fruition or is it a pipe dream. If it is reality, that's a name you may see in the portfolio. For compliance reasons, I'll note that we do not own it right now. Over on the defense side, the Doge scenario is still giving those companies fits. If there's going to be a restriction in spending, if budgets are going to clamp down, you can see some of the results in a Lockheed Martin, down heavy the last couple of months. In KBR, which we own a small piece of, can't get out of its own way. These companies that are showing outstanding growth in terms of estimates, there's a real battle on the minds of traders and investors of whether those estimates are going to have to come in, and maybe significantly. So while the indices, the NASDAQ and the S&P, are fairly tranquil, underneath there's an awful lot of churning. And we like that. That's what creates opportunity. That churn to the market, that sell off into a reasonable entry. And we're starting to see that more and more. I'll add one more thing. We've been on this international bandwagon over the last 8 or 10 weeks, a couple of times here on our Friday review. Again, the bid internationally is solid. It's not going away. Any little drawdown over the last couple of months has been bought and bought hard. Very, very different than what we've seen for the last, let's call it a decade plus. There's been spurts in the past, but when the first pullback came, they continued to drift down. There is demand, and from a fundamental standpoint, you may scratch your head and say, hey, everyone's talking about Europe in a recession and this and that. Markets look ahead. Markets always look ahead. Germany breaking out to new highs. Italy trading very well. Spain trading well. Even over in the Pacific, we've seen a bid to South Korea. Oh my God, South Korea can actually go up. That's unbelievable. So China, we talked about China. Go back 4 weeks ago to our Friday review when I said, you're not going to want to hear this, but there's a real bid in China right now. And it's something that has to be taken seriously. Well, China is ripping, regardless of what you may look at politically and where you may fall politically. Markets are the markets. Some things working, some things not. So stay flexible. Don't get too tied to your opinion, especially if that opinion gets you in an extreme. You think the market is very overvalued. You think AI is cheap and is the way to go for the next decade. If you find yourself very, very sure of your opinion, double check it, because that's usually where you can get trapped in a trade. Enjoy the weekend. We have John Mousseau on the road reporting in.
Hi, it's John Mousseau. I'm the Chief Investment Officer at Cumberland Advisors. It is Friday afternoon on February 14th. Happy Valentine's Day, everybody. I'm at Newark Airport, about to catch a flight back to Sarasota. I was up here on some business. The bond report for this week, tale of two markets. Yields on Treasuries actually down for the week, and you sure as heck wouldn't have thought this if you went back a few days ago. 10-year Treasury bond is ending the week, if you mark it now, at a 447. That is down today for last week about 3 basis points. But it marked a lot of volatility this week. We had CPI numbers on Tuesday and PPI numbers on Wednesday, both higher than expected by a little bit. That sent bond markets higher in yield. And we saw that 10-year bond go into the 460, 462, 463, 464 in that range. And that was a pretty good leap up. And the message was, boy, it's going to be higher rates for longer because inflation is not running away, but it is not down to where the Fed wants. That was reinforced by Jay Powell's testimony on Capitol Hill this week. Then you get to today and you get a retail sales number, which is negative, and down 0.9% when they were expecting a slight positive number. So that was another head turner for the market, and they took yields down decently today, from all the way down from about a 454 down to that 447, and that's just today. So the tenor of the bond market changed. On the muni side, yields were up this week. The 10-year AAA muni yield actually climbed about 9 basis points from a 291 to about a 301. That's a pretty good uptick for the week. And so those yields moved in a higher direction. Why? Starting to get a decent amount of supply finally in the muni market. It's been a while. So they needed to clear out a little bit, so they priced some cheaper yields. So if you think about Treasury yields going down and muni yields going higher, it makes for what is now definitely a cheaper muni market than we had a couple weeks ago. And we're taking that into account as well. One thing I think people need to focus on, though, is the fact that when you look at the numbers this week, January numbers, CPI numbers particularly, tend to be high. They're coming off the holiday season. They were high last year. That's why the year-over-year numbers really didn't increase that much, by about 0.1. So, we deal with these numbers. So you have to take them a little bit with a grain of salt. Same thing when you look at even the retail sales number, because that was probably affected by not only some of the snowstorms that we had in the Northeast, but also, of course, by the devastating fires that we had out in the Los Angeles area in California. So that has to be taken into account as well. And so we'll follow this as we go into next week. But, when you look at some other numbers, for example, initial jobless claims this week, again, a little bit lower than expected, but continuing claims continue to grow. It's a fancy way of saying lesser people than expected are going on the dole, asking for, losing their jobs. But not too many people are coming off the dole. That could be a concern down the road. We will be watching that. We hope everybody has a nice Valentine's Day weekend, and we'll talk to you next week. Thanks a lot.
Thanks, Moose. I hope everyone enjoys Valentine's weekend. We will see you next week. Thank you.